us today. My name is Hannah Greenwood. I'm the Managing Director for Finsbury Associates, and we're delighted to be joined today by Daniel Jolliffe and Oliver Harwood from one of our investment partners, Quilter Cheviot. So during today's webinar, we will be discussing inflation, central bank policy and its effect on the markets, COVID and its effect on supply chain, China, and what everyone wants to know is how we should be positioning our portfolios right now. So I'm excited to get started, but before we do, just to say, if anyone has any questions, please put that in the Q&A box, and we'll either get to that during the presentation or at the end of the presentation. But also, yeah, thank you again to it didn't anyway, there was a bio for both Daniel and but for some reason the slide is not working. But without further delay, thank you Daniel and Oliver for joining us, and I'll pass over to you.
Thank you very much. Good afternoon everyone. It's an absolute pleasure to be here. Thank you for taking the time to listen in. So really the format of today is that it's designed to be conversational. I think Ollie and I, and I'm sure you all have been privy to kind of 18 months of kind of team presentations where kind of people sit and talk at you. And obviously Ollie and I can probably bore you senseless about markets, but that's not our intention. We want to make this as interactive and as informal as possible. And ultimately, you know, our job and what I want to feel that we've accomplished at the end of today is to give you all kind of a clear indication of what's going on, what's happening at the moment, but as Hannah alluded to, ultimately how it's affecting portfolios, and most importantly, what we've been doing, not just recently, but over the past kind of year to 6 months to ensure that our portfolios are in a good position to deal with the current climate that we're in. So in terms of inflation, you know, that's probably the best place to you know, start off really. Inflation is something which is affecting us all at the moment. It's affecting the world, and it's really you know, a knock-on effect from COVID. So what we're probably going to find with the agenda is that a number of the key topics kind of blend into one another, because obviously inflation, central banks, COVID, you know, it's all really kind of interrelated stuff. So the current situation, I mean, you'd have to be kind of living under a rock to realise that the year-to-date financial markets have been very, very difficult to navigate. You know, global equity markets have sold off, and that really has been based upon the fact that there's fears that inflation is getting to, you know, really kind of an unmanageable high position, and the fact that central banks are going to have to be kind of forced into acting kind of quickly, swiftly, in order to kind of quell the impact that inflation is having. But what's really significant in the job that Ollie and I do as an investment manager is kind of disseminating, you know, fundamental kind of market and company specific information from the noise and hysteria which is drummed up by media outlets, whether it be kind of you know, papers or online. You know, everywhere you turn, if you know, there's issues, there's paranoia about, you know, the kind of the end is nigh, and that we should be kind of hiding under our beds and in bunkers waiting for you know, this to all kind of dissipate, and that's really, you know, not the current situation that we find ourselves in. Everything is kind of very explainable, and hopefully throughout the course of today, everyone listening will kind of get value and take comfort from what we state. So look, you know, at this time, there's been some really interesting points in financial markets. You know, it's not all doom and gloom. With regards to US equities, we know that US equities over the last decade have pretty much been, you know, largely responsible for driving the returns that clients have experienced. And why is that? Well, the composition of US equity exposure is heavily tilted to growth. growth businesses. When anyone mentions growth, the first natural conclusion is to think that people are talking about technology, which is largely the case. But when we think about growth, when we talk about growth, it's essentially businesses, and it sounds obvious, that are going to grow efficiently and effectively over the long term. At Quilter Cheviot, we have a strong emphasis on investing in quality growth. And without getting bogged down in jargon, that simply means that we're investing in companies that are extremely well run, have extremely efficient management systems in place, but are ultimately highly cash generative and have significant amounts of cash on their balance sheet. So we feel that investing in that type of company will always produce significant long-term returns for our clients. Why has growth, and in particular technology, sold off recently? Well, that's because central banks have very well signposted the fact that interest rates have gone up. You know, the Bank of England have already increased their central bank rate twice, and it's highly likely that the Fed will follow suit in due course. The impact of rising interest rates is that it discounts the earnings that these growth businesses have had. So they project their earnings for kind of a really long period of time, and once the interest rate goes up, the discount rate becomes higher, and that means that earnings look less attractive, and that's had an impact on the market perception of technology and growth. However, we don't think that this is something that is going to essentially go on for much longer. We feel that this is something that it's had a short, sharp effect. Yes, there's been a lot of volatility, and a lot of technology and growth stocks in the US have fallen significantly year to date. But ultimately, as a long-term investor, we still want to be invested in these businesses. We still feel that's where the growth is, albeit there's been a recalibration in the market value recently. We feel that over the long term, this is something that will investing in these businesses will still benefit our clients, and we still see the value. We're kind of, if we look at earnings season, Microsoft produced some fantastic earnings again across the board. Earnings were significantly, we're just reassuringly good again. Ultimately, everyone gets drawn to Facebook and their results, but there are lots of different headwinds that are impacting Facebook that aren't impacting other growth and technology stocks. So ultimately, there's reasons to be cheerful. I actually see that the recent sell-off has given a lot of people an opportunity to buy into the market at kind of competitive levels that they thought were unobtainable if we had this conversation kind of 18 months ago. Ollie, I don't know if you want to say anything.
Yeah, no, I think you will make very good points there, Dan. I think, and if we look at inflation as a whole, like Dan mentioned before, central banks now, they've had to make a move. But I think what we can say is that Dan alluded to it before, that they've been signposting exactly what they wanted to do. I think if we look back to sort of this time last year, or when the sort of first fears of inflation came around in Q1 of last year, we again saw the same thing. We saw technology stocks sell off, and central banks at that point very much sort of thought that why were we seeing this level of inflation? It was purely down to supply chain, and we heard this magical word of transitory. Now, I think, and Dan and I joke about this, that I think we need a new meaning for the word transitory, because inflation's stuck around for much longer than central banks thought it would at this point last year. And there are a few sources that are at play. It's not just about supply chains, which at this current time is still a bit of an issue. We are seeing sort of transportation, shipping costs, etc., still remaining quite high, but we believe that we might have passed the peak in those issues there. So some of those supply chain issues should hopefully iron themselves out. And I mean, we have to understand that the supply chain was actually created for a period where we're at normal life the whole time. Now, COVID put a stop to that. There was huge demand that came out, and there's a huge sort of demand boom, which really put the pressures on the supply chain. So we can understand why there are issues there. And like I say, they're slowly sort of ironing themselves out. There are other issues and sources of issues that are causing this inflation. Energy costs, for example, I'm sure we're all well aware of that, especially in the UK. Sort of energy prices are at sort of all-time highs and causing a real issue there. So central banks are well aware of that. And then we've also got to look at the labour market, especially in the US. And what we've seen, and what's been quite interesting actually, is when people were in lockdowns, etc., they got a taste of what it might be to be retired. So what we've seen is the labour force coming back into the market, especially those over 55 and over 60, have actually taken early retirement. And why is that? Well, they've seen, like I say, they've enjoyed it. They might have thought, actually, I've quite enjoyed this. I'm going to retire a bit earlier. But they've also been afforded that opportunity, one, because they were paid whilst not working, but two, we've seen huge returns in the markets over the last 2-3 years. Their net wealth has grown from their retirement funds that have grown with that market rise. But then also house prices have increased as well. So they might have had the opportunity to sell their house, downsize, and then retire there. So we've seen a real squeeze in the labour market. So that some of the job numbers that came out last week were absolutely massive in the US, which is a sort of good sign of the sort of labour force out there. So what we've seen is there's been a few sources at play which have really caused this inflation. Central banks have had to move. They're on a tightrope, I think, central banks, because they obviously need to rein in inflation. They also don't want to stunt the growth which is out there. And I think Dan mentioned before, yes, there are sort of moves in the market, etc. But we've also got to look at the growth side of things, which are actually quite positive. Growth for this year is still expected to be about 4.5%. Now, obviously, that is lower than what we saw last year, but we're still well above average sort of growth levels from a GDP point of view around the world. China still leading the way, UK, US still looking very strong. So yes, we are seeing some sort of, I suppose, wobbles in the market, but as Dan mentioned before, we're seeing this as a good opportunity to pick up some very good quality companies. And that's what we have done in the portfolios as well.
So thanks, Ollie. It's really important when we're looking at inflation as well to realise where we've come from, essentially. And you know, if you look at kind of a play-by-play account, I was reading an article over the weekend about a US restaurant, and this gentleman was saying, well, you know, you forget over the last 18 months what has happened to these people. I think to a certain extent we're kind of very lucky in the industry that we work in, but people have had it really, really tough. And this gentleman was saying, look, you know, initially in the outbreak of COVID, I had to lay people off. I had to get rid of pretty much everyone that worked for me, apart from kind of one chef. And then all of a sudden there was all this stimulus that came through, and that helped massively. That was great. And what we saw after a period of time is that ultimately people started going out and spending again, which Ollie mentioned. That's when the transitory inflation got banded around a lot. But ultimately, having laid off a lot of staff, this gentleman was saying, well, then I actually had to start looking around for staff again. But ultimately, people have been receiving checks and sat on their bottoms and trading and all the rest of it because they had all this excess free cash, and then ultimately didn't want to come to work. They said, well, actually, you know, you need to pay me a lot more than what I was getting before to kind of make it worth my while. So his costs go up all of a sudden. Then he's trying to get you know, items into the restaurant to actually cook and to provide people, and ultimately those costs have gone up as well substantially, because everyone's in the same boat. Everyone's trying to run around and get, you know, either materials or food, and the cost has risen so highly because there's so much demand there, and shipping, you know, ports can't hold up to it. So all these costs are ultimately being passed on to the end user, and that's meaning that everything is essentially going up in price. We can talk about, you know, the car industry as well. The car industry is something that has got so much attention because of the lack of raw materials, but ultimately the lack of semiconductors, which are kind of chips that go into pretty much every electronic device you can think of at this moment in time. But because manufacturing was dormant for such a long period of time, it's taking a long time to get these kind of semiconductors available and up and running. And what I kind of really hang my hat on is the word kind of unprecedented. You know, we all know that COVID was an unprecedented event, and if you look at how we come out of it, that's obviously going to be unprecedented as well. There's no kind of key plan that's worked in the past to kind of come out of this. So all central banks are doing is to try and kind of delicately get everyone into a better place and quell inflation by moving interest rates in a higher direction, but it's all been very, very well signposted. And that's really the best that the financial markets can ask for. Because if we do cast our minds back even further to the outbreak of the pandemic in kind of, the dark days of February and March 2020, when we're all, extremely worried, not only for our own health, but for our pensions and finances, and we're really uncertain as to how we were going to come out of this, central banks panicked as well, and they cut interest rates significantly and unexpectedly. And whenever that happens, financial markets hate it, and that's one of the main reasons why markets fell so significantly, is because whilst everyone else is panicking, so are central banks, and that's never kind of a good look. Ultimately, we know that we came out the other side because of all the monetary stimulus that was provided, but for a long time it was a concern. So the fact that central banks now have outlined their kind of stance and the trajectory of interest rates, whether it's kind of 3 or 4 rate rises is irrelevant. It's just the fact that it's been discussed and outlined, and that's the best we can hope for, like I mentioned.
Yeah, and I think Dan makes a good point there. We've had a very strong, obviously since Q1 2020, when we saw the downturn, actually the recovery from there has been very, very, very strong, as we all know on the call. And essentially we've ridden sort of the sugar rush that the central banks gave us with the huge amounts of stimulus they provided the market. Anytime there was a bit of a wobble or a bit of volatility, that was actually just smoothed out because we're riding on the assurances that we had this liquidity provided by the central banks. Now, it comes as no surprise to us, and it was something we were fully expecting sort of when we look at the markets, that as soon as this sort of punch bowl essentially is removed from the markets, you will see some volatility return. You will see some profit takings coming out of the market. So it's not been an easy ride, as Dan says, over the last sort of month, I suppose. But actually, if you look through the noise, there is still some positivity out there. And it's a great question that's come through on the chat there from Mohammed, and thanks for that. It's about any advice on shifting to new sectors now 2 years post-COVID. Now, it's a great question. It's something Dan and I were going to come on to, and it's something that we've actually done over the last month or so, is to look at the market and think, where do we want to position ourselves now moving ahead? With central banks increasing interest rates, where do we want to position the portfolios? Well, we've not done anything too drastic, and we've not made any sort of drastic moves. But what we have done is sort of provide a little bit more balance into the portfolios. Like I say, the sort of tech companies, the growth companies have done so well for us over the last 2 years or so. So what we've done, we've just allocated slightly away from that. So we're still allocated to tech, but maybe where we were overweight before, we've become sort of a more neutral weighting, a more neutral allocation in the portfolio. And we've also increased our allocation to sort of cyclical stocks. So the financials is a great example, and it's a position we've added into the portfolio recently in a holding of BNY Mellon US Equity Income Fund. I'm sure you will all see that in the portfolio. Now, that's actually got a third of the fund allocated to financials, so banks, and predominantly in the US. And we believe that's a place to be. If, like I say, if interest rates are going up, banks will benefit from that. As that's essentially their business model. The margins over the last few years have been squeezed very, very heavily with interest rates at all-time lows. But banks will prosper as we come out of this, and we've seen that rotation year to date. That's really been the best play to have done, and so we were glad to have added that into the portfolio recently as well. But I think one thing we haven't actually really touched on, we've touched on what's happening in the market, but why has it happened? Dan mentioned it before. Everything's sort of intertwined. We haven't actually touched on COVID, which has been, I suppose, a little bit quite refreshing, but I don't think we can totally ignore it, because it is still very much prevalent and very much in our lives. But I think what's been very pleasing to see is all the data that we've had recently, especially on Omicron, is that, okay, it's in our lives, and we have seen infection rates be quite high. Dan, unfortunately, is in isolation at the moment. He's been suffering with it over the last week, so it's still very much a part of our life. But what's been pleasing to see is that the sort of impact or sort of the way we've managed to deal with it as a society is at a much lesser sort of impact on daily life, in terms of infection rates are high, but death rates seem to be lower. Talking in Europe now, the data that's coming out is very, very positive. The only sort of countries that seem to be struggling with it at the moment are France and Germany. We've seen hospitalisation rates are still relatively high there, but we do believe from the data that we've seen, data that was released this morning as well, actually, that it seems to be rolling off there. So as we're looking at the market, it seems that we can get back to normal life much simpler than what we have done before, which has been for us, like I say, as investment professionals, where can we look at it? It allows us to see and take some confidence, really, that we're turning to some sort of normal, whatever that might be. But again, it goes back into the supply chain issues. Will there be lockdowns, further lockdowns? We don't believe that will happen. Now, of course, there could be something left field. A new strain could come out that could be more deadly. But at the moment, based on the data that we've got and the outlook that we've got, things are looking quite positive on that front, which is great to see as we move into the sort of summer months as well, and warmer months. Hopefully we can deal with it in a much better position. You're on mute there, Dan.
Yeah, sorry, I went mute. Ollie alluded to the fact that I'm at home and both kids are howling downstairs, so apologies for that if you hear any strange noises. So yeah, I mean, there are some really good questions that are coming through on the chat. I think a really important point to make is, you know, we talked about the dissemination of what we're doing to portfolios and not getting drawn into kind of market noise. And I think it's probably a really good opportunity just to talk about how we've aligned portfolios, what we've done really over the course of the last year to get to this point. There's a question that came through about being overweight US equity and to diversify into emerging markets. Just from talking to Hannah before we joined the call, you know, it's key that we're all kind of singing from the same hymn sheet to a certain extent, and the fact that diversification is always key when it comes to a portfolio. So ultimately, our portfolios all have exposure to emerging market equities, to Asia Pacific equities, Japanese equities. We look to kind of diversify from a kind of a geographical and sectoral perspective. However, it's important just to kind of align how that works at Quilter Cheviot. So of course we have an investment committee, we have all our analysts that feed in, you know, an extreme amount of data and information to Ollie and I, but we don't have anyone saying to us, right, you know, Ollie, Dan, you better buy this, you better sell this, you know, you better do it now. You know, there's nothing that comes through telling us to do that, because essentially that would make us, I suppose, relatively redundant in a way. You know, we would just be order takers, and that's not how the kind of the process works at Quilter Cheviot. So whilst we do have kind of a set long-term asset allocation model for our portfolios, we have the ability to kind of change to a certain extent the allocations that we have. Now, what's been really important throughout this kind of time period is just to outline that, you know, we have to have a long-term view on what we think is going to drive, you know, long-term returns for clients, but ultimately adapt portfolios short-term if we feel there's the opportunity to drive returns for clients. And I think fixed income is the perfect explanation of how we do things, because we all know that for 40 odd years, people have been able to get competitive returns from holding kind of fixed income in portfolios, ultimately in low risk strategies, and that's worked out very nicely for them. So investors could have minimal equity exposure, significant exposure to fixed income, and because interest rates have been slowly going down, they've been able to benefit from capital appreciation and capital growth from fixed income. We know that that day is now done, and on the way back up, the ride for fixed income is going to be a particularly tough one. So we're having to have conversations with clients as to how to change, you know, the composition of their portfolios accordingly and how to deal with this. So for some time now, Ollie and I have been underweight exposure to fixed income in preference of alternatives. And alternatives can have quite a far-reaching explanation, but it encompasses lots of different sectors, lots of different assets. So we can include infrastructure, property, commodities, absolute return funds, and private equity within what Quilter Cheviot defined to be an alternative. And essentially, it's any asset which can provide an uncorrelated return to global equities. So for a while now, we've been overweighting our exposure to alternatives in order to enhance the downside protection of client portfolios, because every time equity markets have sold off, fixed income has been doing the same thing, and that's no good for us. To have kind of 2/3 of the portfolio falling in value, we need to make sure that that 1/3 is going to be performing and firing on all cylinders to preserve value. So we've introduced, a particular holding, a commodity holding, which has exposure within it to oil and gas. It has exposure to food crops. It has exposure to industrial metals, and that has benefited very handsomely from this inflationary environment. So that is, a trade that has paid off very well. That's a trade that we're continuing to look at as well going forward. But ultimately, we're seeking to diversify the portfolio as much as we can into alternatives to provide returns and to provide some downside protection. Because historically that's come from government bonds, and we know that really government bonds now are simply just a very expensive insurance policy.
Yeah, and I think just popping back to the question as well, there was a question about moving from US to emerging markets, and emerging markets actually last year were the most disappointing sector, sort of geography in the portfolio. They actually ended the year down. So one of the real laggards when looking at sort of global markets and equity returns that we saw. Now, essentially that was all predominantly from China. With China, if they move positively or negatively, that will sort of move the dial on emerging markets as a whole. And the 2021 sell-off that we saw there essentially was entirely sort of from government intervention. We saw them introduce regulations on education, gaming, which, and we have to say, Dan and I were discussing, some of the regulations that came in actually weren't actually too bad, putting sort of time limits on kids and how often they can game, and so getting them away from the screens, which actually might not be a bad thing in the Western world as well. But they also went down heavily on the real estate sector. And I'm sure we all saw the news about Evergrande. I'm sure none of us knew what Evergrande was before this issue, but now we all seem to be experts on the comings and goings of Evergrande there. But like I say, what we saw is the government made it very clear that they wouldn't stand for a sort of exuberance, excess debt, and really a division of wealth within the nation. Evergrande's a great example. They became heavily indebted. It's one of the biggest real estate firms sort of in the world, really. But they were heavily indebted, and the government weren't going to stand for it. So we saw a lot of news and a lot of noise. And what was the issue around that? Well, everybody thought that might be the sort of layman's, the sort of repeat of layman's that we saw back in 2007, 2008, the global financial crisis. And they thought that this might be the layman's moment in China. Now, that's why we saw a bit of a downturn and a bit of volatility around the sort of global markets at the back end of last year. But actually what we've seen is they seem to have rumbled on, and they weren't sort of led to a collapse. And we have seen that sort of even international bondholders have been repaid. Now, a lot of those deals were made behind closed doors, so we weren't privy to exactly what happened there. That's very China, and some of the numbers that come out of China you do have to take with a pinch of salt at times, because there isn't always the greatest understanding of what's happening there. But like I say, that's what caused the sort of wobble in markets last year, that there was that fear that it could cause a contagion and a real sort of domino effect, that they all might start to tumble, but that hasn't happened. But it's just something to keep an eye on, I suppose. But again, we hope that we are highlighting some of the issues that have happened in the market, but actually, we were talking before the call, before we came live here, there are actually a lot of positives, which I've mentioned earlier on, that we are quite positive still on the outlook. We have to look that we have been in a recession caused by COVID, but actually it's the first recession where the man on the streets come out in a much better position. We've got people with a lot more sort of money and savings in the bank because they weren't going out, but still getting paid. We've seen corporate balance sheets are looking very healthy. We're seeing people, companies coming out and increasing share buybacks, increasing dividends. So look, it's been a tough start to the year in the markets, But actually, we look at the sort of rebound that we saw following corporate announcements. We saw 70% of the S&P companies actually outperforming expectations. So we have got to look at the sort of good pictures that are in the markets. And Dan alluded to before where we are looking, and we're looking at quality growth companies, not looking at the speculative growth companies. And where we have seen some of the sort of share price falls, and the Nasdaq at one point was off about 11% this year. Now that was predominantly from companies that didn't have that sort of cash generative business model. So the likes of Apple, for example, they were only off about 2, 3, 4% at the worst of it, whereas the market as a whole, the Nasdaq, were off about 11%. So I think it's been a good example this year of having an active management style. I think that's definitely key when we're moving into the environment we're moving into. You can't have that passive exposure to the full market, because there will be pockets of the market where we wouldn't want to be exposed. But I think we're quite comfortable on where we are exposed now. And a question that's come in before about having an opportunity to time the market, and we think we have. Where we've had cash on the side, we have reallocated that cash and picked up some good quality exposures at very good levels. So moving forward, I think there will still be some volatility in the market. Like I say, we've ridden a really nice wave actually of central banks being so open, and there's been a huge raft of liquidity in the market. Now there will be volatility as that's removed, but that's Dan and I's job to sort of ride that volatility out and really manage the portfolios through. But I think what the sort of start to this year has shown us again is there's no need to panic in times like this. You've got to take sort of stock and take some faith and sort of fundamentals of the companies you've invested in, of the geographies you've invested in, and really just take stock in that and take faith in that as we move forward through it.
Absolutely, and a 10% sell-off is generally seen as a healthy thing in markets, and that's something that hasn't happened, or didn't happen last year. So having a bit of volatility is seen as a good thing. We've all seen the long-term performance of equity markets, but for a long time we haven't really had experiences of a sell-off. This has been the first real pronounced sell-off since 2020, and it has definitely evoked some uncomfortable feelings. But I read an article last week which just kind of mapped out this kind of the year-to-date performance, and it's just another period of volatility. It's not something which is going to go down in the history books as anything particularly significant at the time of writing. I might live to regret saying that on a live webinar, but we're not running for the hills, we're not running for the trees, we're not overly concerned. We're seeing this as an opportunity, and there's bound to have been an impact from the unwinding of kind of monetary stimulus in the US. That was bound to have an impact. So I think we just need to kind of really take a step back and see this for what it is. We're kind of building up the questions now. There's 4, so I think we should probably start ticking some of these off. Let's go for the one at the bottom first. So for those of us who started investing last November when the market was relatively high, do you think the market is low enough now to start buying the dips in different sectors to balance portfolios? Well, absolutely. I think this is the time to start looking at kind of well-run businesses that have fallen in value. I as my day job, I was looking at US exposure for certain clients last week on Friday, and there's a business called Xylem which I like, which is a buy recommendation of Quilter Cheviot, which focuses on kind of the provision of clean water and the technologies that are in play in order to do that, and ultimately it's off nearly 30% this year. So I see that as an opportunity, and I didn't buy any on Friday, but going forward I will look to do so. I acquired Microsoft, I acquired JP Morgan for a few clients. So, it's an opportunity. It's something that I think I need to take advantage of in order to get my clients, the best possible price I can for some really, really well-run companies and well-run businesses that I think in the next 5 years will have made my clients, a lot of money. The next question on the topic of oil prices: where do you see the price going, and how do you feel and also, do you feel some of the unrest in the region will affect it positively or negatively? It's a difficult one to call this. So, like I mentioned, we are exposed to oil and gas with some direct equities that we hold, and obviously through this commodity exposure that I mentioned earlier. A lot of commentators who have a lot more experience of the sector than I have kind of mentioned that they think it's likely that oil will go to above $100 a barrel. So, it's important to kind of sit up and take note of the experts and their view. That's not necessarily a kind of a guarantee. But I think if we do get to a situation in Russia, with this tension with Ukraine, and whether it escalates into a full-blown war, you're kind of coming up with hypothetical scenarios here. But my thought process would be that potentially they might make oil more, less available. They might cut off supply to a certain extent, and I think that will have a positive impact on price. So I'm kind of monitoring it, thinking that could be one way it goes. However, predicting these things is extremely tough and extremely difficult. So it's important just to outline, because this is something that Hannah and Ollie and I were talking about kind of pre going live, is that anytime there's a war, of course there would be a market reaction, and the initial reaction is not going to be particularly positive. However, I think Ollie's point, which he mentioned, was that over the long term, these things don't actually tend to have much of a significant impact on the performance of financial markets, which sounds horrific, because ultimately there's a human cost that comes with any war. But we feel that after kind of a short period of kind of volatility and sell-off in markets, that things would ultimately recover and rebound.
Yeah, and I think one thing that's also playing into the oil price at the moment is that there's a bit of a cold snap and storm that's whipping through America, which is causing the oil price to be where it is as well. So there's a few things working to keep the oil price where it is. I think it's Goldman Sachs that came up with a $100 oil price target, and if that conflict does go into an all-out war, then we would see the price rise again. And I think Mr. Putin is doing all he can to keep it as high as possible, because it makes him even more powerful as well. So it's definitely something we're looking at. It's a geopolitical risk that we're well aware of. As Dan said before, we can't really guess which way it will go. But I think, again, what we'll do is just hold course. I don't think you can position yourself any which way for a conflict. But over the longer term, it would just be a blip. No, we're well aware of it, and we're keeping an eye on it, absolutely. There's a question here about whether the S&P will finish over 5,000 this year. There's been a few suggestions as per the question. And I mean, where we are at the moment, I think the S&P is about 4,500. Again, it's not something we look at. There's no sort of, we don't sort of expect the S&P to hit certain points. We just look at the underlying companies and focus on the companies that will, we believe, do well going forward. So yeah, we're not too, I haven't really got an opinion too much on exactly where they might be, but no, we do believe that the US, in terms of growth, is still looking strong for this year. And we, like most portfolios we are heavily invested in the US, good quality companies, and very confident with that exposure.
Yeah, great. I think there's a question as well, thoughts on future investing into companies for the metaverse and NFTs. So I'm not going to sit here and pretend to be, someone who's experienced particularly in NFTs, but how we kind of cover this is that we do have kind of thematic exposure within portfolios to technology, and that gives us, we feel that the person running that exposure is an expert in their field, probably one of the only people in the world that we would want managing that exposure, because they live and breathe everything to do with technology, and therefore we want to have exposure to these kind of, well, to the changing landscape, being kind of the metaverse, etc. So what we have to be careful of is that kind of emerging technology companies have been worst hit by this kind of issue with inflation and the discounting of earnings, and it's really been kind of the stable players in the industry that have, you know, these strong kind of cash generation qualities that have been able to kind of stand up to the volatility. So whilst we want to have thematic exposure, it's been a bit of a tough ride over the last kind of, you know, over the last 2 months, to the point where sometimes I've turned to Ollie and said, Ollie, I'm getting a bit twitchy about exposure to thematic technology. Is this something that we should still hold? And it's about kind of remaining true, like I said earlier, to your long-term vision. Do I think that clients can financially benefit from this exposure in the long term? Absolutely. So yes, you know, there's been volatility in the short term, but long term, I think NFTs and the changing metaverse is something that we need to very much have exposure to, because I think this is going to be a key area.
I think that feeds into the next question, Dan, on healthcare as well, because healthcare, again, it's a theme that we've liked. It's a theme we've been exposed to, but it has had a tough year. It's quite a disjointed market, or a disjointed sector, very similar to tech. There are good companies. There are some companies that haven't performed as well as they might have liked. So we have seen that it struggled over the last year, healthcare as a whole. But when we're looking longer term, we still very much like the sector. It's a sector that's growing. There's new technologies that are coming in. So there's some really exciting companies. And some companies that have reported very, very strongly over the last recent earnings season as well. So still a sector we like, still a sector we have exposure to, and will continue to have exposure to over the longer term.
So ultimately, you know, what we've been saying, hopefully the theme of this conversation today is very much one of positivity, albeit, you know, I think our Chief Investment Officer said, you know, he was cautiously optimistic, as are we. You know, I don't see that there's an issue here that will affect markets for the long term, but we are going to see an increased level of volatility. However, I think it's well documented, well versed, that we have been using that as an opportunity within client portfolios. Ultimately, as well, in terms of our view of how it impacts portfolios, we've just installed balance. Now, I won't bore you again with the fixed income and alternative scenario, but within our equity exposure, we, for the last year, have been increasing the balance that we have in portfolios to oil and gas, to banks, to you know, materials companies, in order to just not be so heavily focused on quality growth. And that's not to say that we don't believe in quality growth. I think everything that we've discussed today, you know, should say that we do, but it's balance within portfolios that we need. And that's something that has aided us to kind of weather this kind of tumultuous period at the beginning of this year particularly well. So look, you know, ultimately positive with regards to the outlook. And Ollie and I, we also work with a colleague called Mike, who couldn't join the call today, but we're constantly having dialogue and conversations regarding how we can tweak portfolios and align them in the best possible way we can to ensure that that client portfolios are protected on the downside, and that once markets start performing, that, you know, clients will financially benefit from a bit more momentum in global equities.
Yeah, and I think just to follow on the final point, I suppose, just following on from what Dan said there, it is a tough time, and nobody likes to see volatility in the markets, especially Dan and I. We have to live and breathe it every minute when we're in here and at home as well. We're texting each other after work. But I suppose what we want to do is, if any of you have any sort of questions or would like to know anything when markets are moving positively or negatively, please feel free to reach out to Dan, myself, or Mike. We'd be more than happy to jump on a call, talk things through, and just let you know what we're thinking there and then. Be more than happy to do that.
Indeed. I think the reason why we haven't had many requests for kind of review meetings is because our team ethos is kind of engagement and being accessible, and that has meant that we've had lots of kind of conversations with clients over the last 18 months about their thoughts on what's happening in volatility, etc. So we are accessible. You know, if anyone wants a one-on-one meeting, we can facilitate that, and if anyone wants just a few paragraphs on our, you know, what we think the market's doing either now or in the next couple of weeks, then we're more than happy to do that. So anything that you require, just let us know, basically.
Great. Thank you so much, Daniel and Oliver. That was really, really helpful. I think, look, you echo exactly what we say to our clients, which is, you know, there is going to be volatility. There are a number of things that are in the background, but actually using that volatility to our advantage, making sure that we are kind of making those kind of regular contributions into your portfolio, and really, yeah, just making sure that you're diversified so that you don't kind of get that huge swing on one sector.
Absolutely.
Great. Thank you so much for your time.
Pleasure.
No, thanks everyone. Thank you, Anna. Yeah, thank you, everybody.